Hello, my name is Blaine Anderson. I'm a certified financial planner with Bander Wealth Management. I'd like to share with you a tax and an investment approach, a strategy. Perhaps this is for an investor that has had a recent capital gains this past year. I'd like to share with you a case study. I will, of course, omit the client's name and any personal details, but this is an actual case, and I'd like to share with you the data. Perhaps there's some principles here that can apply or help you as you consider tax and investment strategies after the sale of a property, in this client's case, their business, or even your stock portfolio. I'm going to share my screen and share a few details. This particular client was referred to our office through their tax professional. The reason for the referral is that they have a taxable gain of $900,000 this year. They were able to partially sell a portion of their business. This particular client works as a medical professional and was able to sell part of his practice. According to his CPA professional, we're looking at a 26.3% marginal or tax rate on this $900,000 gain, which will result in a likely tax obligation of $236,250, according to the client's tax professional. What we've done is taken a three-tier approach. And what I'd like to do is share with you how we estimate a tax savings this year of $94,230. So we at Bander Wealth Management, we often look to apply a tax and an investment strategy. This is our work as tax smart wealth advisors. The three tiers include number one, an oil and gas investment, number two, an investment into real estate opportunity zones, and then also a portion that's invested in one of our actively managed Bander ETF portfolios. This helps maintain a level of liquidity, but also provides diversification for this portfolio. So we're looking at a $900,000 taxable gain. And according to the client's tax professional, we're in a 26.3% marginal tax bracket on this 900,000. The first approach is to consider an oil and gas investment. This is for accredited investors, meaning the investor has $1 million net worth. And what we've looked at is taking and investing 200,000. From an investment standpoint, we will likely spread this out over 2 or even 3 oil and gas investments. We perform our own independent due diligence on these offerings. An oil and gas investment is an investment, a long-term investment with an expectation for monthly distributions based on the pricing of oil and gas as well as the production of these wells. From a tax standpoint, it also will provide a 70 to 90% tax deduction on the invested amount. So in this case, $200,000 being invested, we expect a year one tax deduction of $160,000 on the oil and gas investments. That's using an 80% estimate. Like I mentioned, it can be a range of 70 to 90%. Now, we do have an expectation for cash on cash returns. Usually they'll start in the third or the fourth quarter of next year. However, I think it would be most appropriate to discuss the merits of the individual oil and gas investments in a separate conversation. But I want to give you a general high-level overview of what we expect from a tax and an investment standpoint. So $200,000 invested in oil and gas, we expect $160,000 tax deduction for this year, and then ongoing tax efficient income. This is an illiquid investment. Now, from a real estate standpoint, as part of the Jobs Act and the Tax Reduction Act of 2017, we have an opportunity to invest in real estate within opportunity zones. I'm happy to share more details around this investment. It's a real estate investment. We absolutely have an expectation for returns. But from a tax standpoint, there are two things that we can achieve. Number one is a tax deferral. And so what that does is defer that capital gain through 2026, which means the taxes are due in 2027. The second part of this, something I really like as a long-term sort of investor and as a certified financial planner, is that those funds that are invested, in this case, $200,000, the growth on those funds, as long as they are invested for 10 years, can be tax-free. So the appreciation on that investment is tax-free, and therefore, to me, has some Roth-like characteristics. So when we apply that here to this strategy, we get $200,000 of tax deferral. So what that does is reduce the tax obligation now. Now, it's important to mention that these funds have some planned liquidity events, and I would enjoy the opportunity to share with you the individual merits of an opportunity zone investment. These are real estate investments that we've underwritten and performed due diligence on, and we go through those with each of our accredited investors. What that does, though, is reduce the taxable gain for 2024 in this year with this client by $360,000. So, as I previously mentioned, they had a $900,000 taxable gain. Now that's only down to $540,000. So what that does is go from a taxable obligation, an expectation of $236,250 down to $142,000. Therefore, an estimated tax savings of $94,000 for this year. As I mentioned, there's certainly a discussion and key considerations and points around the future cash flow of these investments, the individual merit of these investments, and it's important to consider and review a PPM on each one. That's a big part of what we've done as an investment advisory firm. I would love to share with you some of the individual details, but I thought I would share this case study from today for a client that has a realized gain of $900,000 this past year, and how a combination of a tax and an investment strategy can work together for their long-term goals and objectives. Thank you.